Everybody, welcome back to the Weekly Rebalance. We are at the end of the year, so we have Nick and myself here ready to cover some research and market update for the year. I'm ready to get into it. Are you ready,
Yeah, let's
Nick?
dive in. Let's dive in.
Sounds good. So we're at the end of the year, so this is going to be our end of year New Year's edition. And I figured, we still got one more trading day of the year. It's December 30th when we're recording this. So this isn't final for the year, but I figured we'd do a recap, like a 2025 scorecard for the year before we got into some research and look forward into 2026 a bit. Does that make
Yeah,
sense to you, Nick?
I like it.
So, I mean, it was an interesting year, Nick. The, I mean, we're still having double digit returns,
I
right?
know.
So now we've had 3 years consecutive of double-digit returns in U.S. markets. But the big differentiator was U.S. equities, while they did well, the S&P was up 17, almost 18%. The Dow Jones was up 14.5%. The Nasdaq up 20, almost 21%. So we had some great performance there, but we had a lot of the rest of the world actually do a lot better.
Yeah,
So developed markets up 32% almost for the year. If you use the MSCI developed ex-US,
yep,
32% positive. Emerging markets positive 32% as well. So a lot different than, even though we had double-digit returns this year, a lot different this year than the last two years.
definitely. And we saw more volatility in the U.S., particularly in April.
Yes, yes, particularly in April. So let's walk through that real quick. Nick, you want to give us the timeline of the year?
Yeah, absolutely. So here, I've got a couple charts I can pull up here.
Okay.
I prepared this out of the way here. All right, perfect. Yeah, here I've got the equity returns for major market indices globally and specifically in the U.S. here year to date. In the blue line up here, we have the MSCI All Cap World Index, excluding the US. And you see that performance, like you were talking about, just excellent performance abroad here, 33.18%. So great year for international. And then in addition to that, I brought in the S&P 500 and the NASDAQ. So NASDAQ having a year 22.52% year to date, and then S&P 500 18.97% year to date when I pulled this. So um, been a great year for all three of those, like we mentioned earlier. But I think one of the more interesting things to dive into here is this pullback that we saw specifically in the US, but also abroad when we got the tariffs announced. And you can see US market in particular got drawn down more heavily. I mean, it makes sense. It's a US announcement. International markets felt it as well, but U.S. markets getting hit with a lot more volatility than abroad here, and we just see that in this chart. And it's interesting too to take a look at the composition of the returns when we look at them at a year to date and see where they actually came from. Because here at the bottom of this trough on April 8th, if we look at the returns since that time period, then the Nasdaq and the S&P outperform. But over the year to date time frame, because we had that drawdown uh, earlier in the year, all cap world index just performed more steadily and had a better year to date return overall. But interesting to note that we've got great performance here from the NASDAQ, specifically from the bottom of the trough.
Yes. Yeah, absolutely. Well, the other interesting story for the year too, and it started with the tariffs in the beginning part of this year, is the dollar. The dollar abroad, the U.S. dollar
Yeah.
severely depreciated, which
Yep.
helped the return of emerging markets and developed markets as well. And that's something I think we need to pay close attention to going into 2026. Would you agree with that?
Oh yeah, absolutely. And I mean specifically just with Fed policy in mind as well, with the new Fed chair potentially coming into place. I think a lot of managers, specifically in the fixed income space, but even equity managers as a whole, are keeping a close eye on inflation, specifically at the long end of the curve, and seeing how all of that will play out, assuming we get more cuts in 2026. I think we'll get for sure at least one is the the consensus. We had the Fed minutes published today, and it seems like there's some growing sentiment that pressures to inflation are growing and becoming more and more concerning among the open market committee. So going to be an interesting one to watch.
Yeah, definitely. Well, and speaking of the Fed and the macro picture, we have started to see some cracks in the labor market, and especially with initial jobless claims and some other metrics that we'd look at for the labor market. That's another big concern going into 2026 as well, which is boosting the projections that the Fed will continue to cut rates in 2026.
Yep.
So, which again ties to fixed income. So, getting into fixed income a little bit, fixed income really just if you were invested in fixed income, rates came down generally for the year, and fixed income, most fixed income portfolios did pretty well.
Yeah, absolutely. And we see that here. I went on ahead and brought this up as well. This is the Bloomberg aggregate year to date, 7.45% for fixed income, just excellent returns. Um, in the context of the S&P returning 18%, that sort of thing, maybe it starts to dwindle a little bit in comparison to that. But overall, just great return.
Yeah, absolutely. I hesitate to think that nice of a return will be in place next year. I mean, it's hard to say. You never know. But, you know, that's equity-like returns right there in fixed income. I mean, the average equity
Yeah.
returns, our average annual equity returns are not that much higher than that. But, fixed income returning 7% plus in a year is really great. I think the issue going forward for next year is that is coming from a massive yield curve shift where
Yes.
yields came down significantly, just really across the board, which you have up on the screen now.
Yeah.
But we would have to see that happen again for fixed income to return at the level it did this year. So I think it's still possible that we have positive returns in fixed income. That's very likely. But having a 7 to 8% year, in my estimation, would be pretty unlikely for 2026. What would your thoughts on that be?
Yeah, I definitely agree. I mean, this chart illustrates it well. We saw the yield curve come down pretty substantially. Got a number of hikes in 2025, helping bring that curve down, especially on the short end here.
Yeah.
A lot of good bullish steepening. Now, I think the interesting thing that I noted when I was taking a look at this was the 30 year specifically, and actually we're slightly higher on the 30 year than where we were this time last year. So.
Yeah.
Some inflation expectations there. I mean, additionally, we just had a lot more room to come down with the short term, the short end of the curve, and more directly impacted by Fed rate cuts, that sort of thing.
Right.
Just interesting to note that as well, since we actually saw that creep up a little bit. Maybe as some inflation concerns begin to rear their head a little bit more.
Right. Yeah. So as yields come down, prices go up. So we obviously had people bidding up the prices of those bonds, which boosted the return for the year for existing bondholders. Great for those bondholders. I think if anything looks different next year, I think fixed income is one of those items, one of those asset classes that will look different. There are some other asset classes that I think will look very different in 2026 as well, which we'll get into in a little bit. But that's definitely one that seeing a 7 to 8% return in fixed income is definitely something not something you see every year.
Definitely not. I mean, it really in the whole context of things, just excellent year for pretty much any sort of asset. Equities, 18% or almost 19% in the S&P. Maybe not the same return that we saw the past 2 years, but those were also exceptional years as well.
Right.
International equities also having a great year. Precious metals in particular, we've talked about those a lot, and fixed income as well. So
Yeah.
overall, great year for just about any risk asset, except for maybe Bitcoin, crypto.
Yeah, that's like we were talking. Pretty much every asset class did well and had positive returns. Gold, silver, all the commodities doing pretty well, but Bitcoin really lagged this year. Actually, are we still negative for the year on Bitcoin?
Yeah,
I think we are.
yeah, we are.
Mhm. Um, What do you think on that for 2026, Nick?
Yeah,
Good
I mean,
time to buy? Wait.
it's one of those things, we touched on it earlier this year at 88,000, which is where we stand today. Um, it does seem like a decent buying opportunity if you're a long-term holder. That being said, we've seen it pull back at similar levels in history. So I think it presents some elevated risk if you want to just dump in tactically. I might be looking for a little bit of a lower price point. But that being said, again, for someone who's doing a disciplined dollar cost average and they plan on holding it for a long period of time, this does seem like a decent buying opportunity. Uh, just in the short term here, I don't know that I see the catalyst to really push it back up to those highs that we saw earlier this year. Just at this point, I think a little bit more risk than I would be looking for a real large tactical move.
Yeah.
Again, that being said, for a long term holding, decent time to buy.
Yeah. Yeah, I tend to agree. I think you know, yeah, I think that makes sense. So for our research of the week, we really wanted to look back on 2025, take some lessons from 2025, and look forward to the 2026 playbook. And we touched on this already a bit, but going forward, it's at least my estimation. I think you're on the same page here, Nick, that going into 2026, there's likely to be some differences that 2026 and really even beyond into 2026, if we were to do a 5-year projection or a 10-year projection, I just think that 2026 and the following decade from here is unlikely to look like the past decade. That doesn't mean we're bearish on AI or anything like that, but I just think that there's very likely that we have more breadth in the market. Small caps maybe do relatively well, comparatively speaking, to what they have been doing. International may lead. Just a very different environment than we've had the last decade. That's at least something to watch very closely for. Um, just unlikely that the last couple of years of U.S. high growth mega cap tech is just the only asset class that performs like it has.
Agreed.
You agree
Agreed.
with that?
Definitely. I definitely tend to agree. I think a lot of people are calling for a broadening out of the market, which I think likely will occur in the coming years. Additionally, I think maybe a shift back into focusing on fundamentals as opposed to maybe just specifically targeting growth just in and of itself, but returning to a little bit more of a fundamental market potentially as well. Uh, but yeah,
Yeah.
I tend to agree that it's not going to look the same as the past 10 years.
Yeah, absolutely. So if you're a portfolio manager and you're doing research trying to position yourself for 2026 and beyond, which you are a portfolio manager, but if you were talking to you're sitting here talking about your CIO angle, how you're gonna put your portfolio together for 2026. If you had to give two or three things that you would focus on, what would you do?
Yeah, I mean, it kind of goes back to what we were talking about earlier. I think this year actually did a great job of highlighting some of the really important tenets of portfolio management. Um, one of them is staying disciplined, and again, that's kind of a gimme. That's a freebie, but discipline very important. It's going to be just as important in the coming years. But this year we saw it in specific. People who got very concerned when we were about 20% down back in April and sold out, missed out on a huge rally like we saw earlier. So again, that was one of the things that was highlighted this year, and one of the things I would take forward into the coming years. Just always a good idea to be disciplined in your portfolio management strategy. I don't think that that's much up for debate, but
Yes.
wanted to highlight that because I thought that this year was a great example of that. Uh, Additionally, just staying diversified. We've had a notable amount of international exposure in our portfolios for diversification purposes for a number of years. And while it's underperformed for some of those years, We're coming into a period here where international is becoming more and more favored. It's performed very well for us this year. We think that there's a lot of good tailwinds for that going forward. So again, just staying diversified and sticking to your story. While it's easy to, kind of give up on that story of global diversification, reduced correlation of return streams, that sort of thing. While it's really easy to turn code on that when maybe the returns don't look as great, the fundamental theory behind that is still there. And so sticking to your guns on that, that's another thing I would carry into the coming years.
Yeah, absolutely. Yeah, totally. I think it's going to be an interesting 2026. So if you were going into 2026 and you're an advisor, portfolio manager, would you pick to be active or passive?
Oh, that's a tough one. That's a broader question as a whole, I think.
Yes.
In 2026, though, in particular, I think there's definitely going to be some value in being active and taking different positions outside of the benchmark. Again, like we're talking about, these cap names that have performed very well make up a huge portion of the major indices within the U.S. They're probably going to continue to perform well. They're great companies underneath. That being said, they're probably not going to continue driving all of the performance or be, the front runners. I mean, they weren't even the front runners this year in terms of performance within the S&P 500. So
Right.
being tactical and moving into other names and adding allocation to names that in a true market cap weighted benchmark that's passive, you're not going to have a ton of exposure to. I think it's going to provide some value. Potentially also, you might miss out on some of the downside, which a lot of famous investors say the alpha that they generate is not so much on the upside, but it's more on missing out on some of that downside. So I do kind of like that active tilt here, but I think we're a little bit biased on that answer.
Yeah, potentially. But we have a lot of passive strategies in place as
Yeah,
well. But I think you're right. There's a couple places I think are particularly interesting where regardless of the level of active management, there are places in the market that active management is more valuable than others.
yeah,
And I think that's particularly true in small and mid cap. There's
absolutely.
less efficient markets there. So if the markets are less efficient, the opportunity to provide some value for, an increased active exposure is something that makes a lot of sense or can make a lot of sense. Same thing within fixed income. That's, for example, in our fixed income portfolio, that's a place where we've consistently been moderately active and been able to provide value consistently over, more than a decade now.
Yeah,
And that's just those two markets in particular, that's a place where there's a lot of opportunity there. It's very hard to be, I mean, especially the last decade, to
yeah,
beat just the S&P 500. I mean, the mega cap tech, the larger the size, the better it's performed, and passive indices have been massive beneficiaries there. If we go into a period where that's not the case and more mid-cap type companies or small cap companies tend to do well, um, it's a different environment. Same thing in international as well. Um,
yeah,
I think there's a
absolutely.
lot of opportunities in international emerging markets in particular. Just you're looking at less efficient markets. So anytime I'm not gonna sit, I don't want to sit and advocate for passive or active, right? Because I think you can argue, either side. But I do think if I had to, uh, you know, provide advice to anybody that's trying to decide if they're active or passive, if you're going to, certainly those markets that are less efficient are places where being active can provide additional value. And we may very well be going into a period where those type of markets are actually likely to be, some of the beneficiaries, some of the better performers. So
Certainly.
it's something interesting to think about.
Definitely. And I mean, just also at the macro level as well, we don't even have to get into security selection, but also just at proper, or you can create alpha through allocating to different asset classes, even if the asset class exposure that you're getting is passive. The decision to overweight international, for example,
Right.
that's a good um, potential way to add alpha. So um, again, yeah, like you said, I think there's a lot of exciting stuff coming for some of those less efficient markets that maybe have lagged in the past few years. And again, I think decent time.
Yeah,
Decent time to change some
absolutely.
allocations.
Yeah, absolutely. Well, there's, if we do see a broadening out in the S&P 500 and more of the mid cap names that are in the S&P
Yeah.
um, do well. I mean, those are tiny, tiny weights in the
Oh
S&P
yeah.
500. I mean, you're talking about like 0.1%, less than that,
Yeah.
actually.
Yeah.
0.01%,
Yep.
0.02%. They're not impacting the S&P 500 hardly at all. I mean,
No.
you could get the return from the S&P 500 by owning 50 names, even
Yep.
less than that, arguably. Uh, it just, so if those other 500, 450 names are likely to do well, if we think they do well, there's an opportunity to select good quality companies and allocate to them and have good performance from it. And I think that's another thing to looking forward into 2026, something that I would favor high quality balance sheets, just high cash flow, low leverage, and just, look for quality. And that's something that's, boring sometimes. I think a lot of investors, that's not exciting, but it's something that over time tends to pay off.
Yeah.
Quality usually comes through, not during all times, but I mean, perfect example this year, the one of our favorite indices, the Dividend Aristocrat Index, which is all companies that have increased dividend payouts for 25 years, which is just a really solid indication of balance sheet quality if you've been able to do that for that long. And if you look deeply at the companies inside of that, that's true. And those are that's an unloved index this year. It's just
Yeah.
those names were not loved. But over time, if you look at a 40, 30, 40, 50-year period, that index, that quality of an index, which is very restrictive, it's about 65 companies, actually tends to do very well, if not beat in a lot of longer term periods, actually beat the S&P 500. It does it exactly the way that you mentioned, Nick, which is on the downside, it doesn't have nearly as far to fall. The companies are maybe they're less exciting, right?
Yeah.
But their quality, and that is something that comes through, especially if we have volatility.
Yes. Yes. Another thing that we've touched on a lot this year is liking value as a whole, and that's something that long-term trends have showed us has value, for the lack of a better term. So
Right.
uh, again, another thing that we're kind of going to be looking for in the coming years.
Yep, absolutely. Totally. Well, sounds good. Well, I think that gives us a good picture for 2026. You want to wrap up with some trivia, and then we'll head into the new year.
Let's do it.
Sounds good. Well, I have one very easy question that we kind of already answered, but I wanted to
Okay.
highlight it
Okay.
again. So if you get this wrong, I'm going to be really disappointed, Nick.
Yeah, I'm going to be disappointed too.
All right. Okay, for 2025, what performed better, the US or the international developed markets?
International developed market.
Yep, absolutely. By a pretty significant margin, as we talked about already this year, or already in this conversation.
Yep.
I told you that was an easy one.
I was concerned. Usually those easy ones are a little bit tricky.
That was really easy, though.
That one
So,
was that. Yeah, that was a good one.
yep.
I have one that's less easy. I
Okay, let me
I
see if I
think
can get
there's a
it.
chance that you get this one though. This one's
All right.
not like some random obscure historical fact. So, taking a look at year-to-date returns, reflecting on 2025, what was the top performer within the S&P 500? And I'll give you a hint. They were only included in the S&P very recently. So, I think it's a little bit shady to include their year-to-date return in this, but if they're in the S&P 500 now, they're the best performing year-to-date stock within the S&P 500 currently.
Okay. Just an individual stock, not sector stock.
Just an individual. Yep.
Palantir?
Here's up there. They're fine. 143.5%.
Okay, so it's not Palantir though.
Not Palantir. Sort of, kind of in a similar realm. AI related.
I'm not sure.
It is SanDisk Corporation.
SanDisk. Interesting. Okay.
578.5% year to date.
Wow. I did not know that. Yeah, my guess was Palantir. Huh.
Yeah, they were only included in the index relatively recently. I think back in October they were added. But a great year for them nonetheless. I'm focusing on storage, providing storage for all these data centers.
Yeah.
Again, some of these names, I think, really, I've got the top 10 here within the S&P 500. At least I think I grabbed the top 10. Yeah.
Yeah.
A number of these are, second order beneficiaries of the AI trade. I think one of the most interesting ones here, Fix Comfort Systems USA, specializing in cooling, 125% year to date. So really benefiting from the need to cool all of these really energy intensive data centers and such. So we're kind of seeing that start to play out more and more. Another one that really surprised me was Warner Brothers Discovery, 172.4%, no doubt related to all of that merger M&A activity that we've seen recently. Did not expect to see it on the top 10 list, though.
Yeah, I didn't expect that either. Well, a lot of that's come recently with the Netflix conversations.
Yeah. Micron, not too much of a surprise there. Would have been up there for a guess, but SanDisk leading the way.
Huh.
Specifically memory, though. I just found that really intriguing because, SanDisk, I think of the little cards you put in your camera, the old cameras,
Right.
So I don't know. I found that really intriguing because they focus on a very specific segment of the market.
Yeah.
Another one that was up there in the top 20, I think, was GE Vernova. Another one that's very clearly tied to the AI trade, but maybe not one of the first names that you think about when thinking about AI.
Right. That makes sense. Huh. Interesting. Well, that was a good question. You stumped me.
That was a fun one. I do have another one, but I don't really know how to phrase it. It's a lack of.
Well, give it a shot.
All right. Let's see. I'll phrase it. 9 of the 10 central banks overseeing the 10 most heavily traded currencies in the world lowered their benchmark lending rates in 2025. Can you take a guess as to the aggregate amount of rate cuts and basis points that were cut globally within those 10 major currencies that are traded?
Okay.
So just like the total amount of rate cuts we've seen globally, not just in the US, but globally, within these main.
So like a cumulative, like if the US cut 50 basis points and someone else cut 50, that'd be 100.
Yep, you got it.
Okay. You want it in basis points?
Basis points, percent, doesn't matter.
I'm going to guess 2,500 basis points.
Whoa. That's good. No, I like it. It was 850 basis points, which I think, in the context, I was reading this article about it, and they were talking about how large the rate cuts are and how we haven't seen global rate cuts at this level since 2008, 2009. I was expecting a higher number as well. I mean, I know that we've gotten a number of cuts in the US, but, we've seen it England, the Euro, just tons of central banks across the world cutting rates. So 850, definitely notable, especially in the context of we haven't seen global rate cuts like that since 2008, 2009. Contributing to the great returns in fixed. But the 850, I was like, wow, is that really it?
I overshot by a lot there.
Yeah, I mean, I don't even know what I would have guessed.
Yeah, it's not a number that I typically, put
not
together.
One that I follow.
Yeah,
and also in aggregate, what does that really mean? Like, it's kind of one of those meaningless numbers. I just found that intriguing.
Yeah, it's interesting.
Really a global cutting cycle.
Yeah.
So I guess with the exception of Japan, but
Totally.
very interesting.
Sounds, yeah, very interesting for sure. Awesome. Well, I think that wraps up the New Year's episode. Happy New Year, everybody, and we'll be back in 2026.
Thanks,
Thanks, Nick.
everyone.
Thanks, everybody.